Correct. So that's a powerful point, sir. Valuation discipline becomes especially critical in late cycle optimism, and which leads us to naturally to risk architecture. So, my question to you is, what does robust risk management architecture look like in the current environment? How should investors think about drawdown thresholds, rebalancing discipline and capital preservation without becoming overly defensive? Over to you, sir.
Correct. Yes. So in terms of risk management, again, the very fundamental step is to identify risk at the company level, where your money is actually going, and not look at the ticker, the stock, and try and study the fluctuation of that stock. And specifically, we have seen that something where the price is going up, that's a good stock. When
Mm,
the price is falling down, it's a bad stock, a bad
mm,
company.
mm.
That's not the case. The fundamentals drive the goodness of a particular company in terms of how strong the balance sheet is.
Correct.
Is it consistently able to generate positive cash flows?
Mm,
What is the efficiency of those cash flows vis-a-vis the invested capital?
mm,
Which also shows the kind of persistent advantages the company has, the pricing power, the product portfolio, the demand of its services.
mm.
Everything is indicative of, from the efficiency of capital deployment
Yeah.
and the kind of growth the company is able to pursue, based on, good capital allocation and coming up with the product and offering which are required. Right?
Mm.
So these are the fundamental aspect of risk management. So we are absolutely not believers of price, kind of stop loss or price action related risk management that you sell. If you anticipate market will fall, then you sell out of it.
Mm.
It cannot be done, in a sustainable way. Once or twice you might think that you have cracked the code, but that's not the case. So you have to remain invested even in a risky asset class like equities,
Correct.
while you go through all these kind of global uncertainties. And the only the defense that you have is basically you don't overpay.
Mm.
So you don't chase the stories that are evolving in a particular
Mm.
time frame, and everyone really loves that, and then even the justifications are there, to support that kind of valuation. But you have to maintain valuation discipline, and then you have to maintain the fundamental discipline of not going beyond your comfort zone, in the sense that, okay, if you don't invest in heavily leveraged companies, you don't do that. If you don't invest in, let's say, loss making companies, then you don't do that, even if the narrative is very strong that, okay, this is the company has taken some kind of a transformative
Mm.
actions in the past, and now is going to be the leader and so on.
Correct.
So you have to follow discipline on both parameters
Mm.
and continue to have diversification, as I said repeatedly, across various growth vectors, across various asset classes.
Absolutely. So that's a so that's an excellent idea. So risk management is not about fear; it's about structural preparedness. Let's now shift to a particularly important dimension: long-term sustainability. So my question to you is, uh, in your report, uh, the science of retirement planning, navigating hidden risk in a long retirement. You highlighted inflation risk, longevity risk, and sequence of return risk, suggesting that traditional fixed income heavy strategies may require 30-40 times actual annual expenses, whereas a disciplined equity oriented framework may sustain outcomes closer to 20 times. So the question is, how should long-term investors structure portfolios to balance growth, withdrawal, sustainability, and volatility management, especially during the critical first 3 to 5 years post-retirement? Over to you, sir.
Yeah, so that's a very interesting report that we came out, and specifically it talks about, while wealth creation long-term compounding and investing in the right asset classes. That is extremely important in the initial phase of accumulation and growth. What we have seen that even when it comes to the distribution phase, wealth distribution phase, when you start consuming your wealth that you have created over the years, we have seen that again fundamental principles of the how you deploy capital at that end, how you at what structure that you follow in terms of draw rates and so on are extremely important, right?
Yeah.
And people don't understand, many people don't understand the real risks that are still there. Like
Yeah.
even if I have invested all of my money in FD,
Yeah.
it's not that I am not taking any risk, right? So the with changes in medical science and your life expectancy is evolving, right? So we, even if you let's say retire at 60 degree, you have to be potentially prepared for next 40 years, right? And in that case, going to a fixed income kind of a security for your portfolio is extremely, you are in for a rude shock, because very soon in next 20 years you will practically run out of money, or you will be spending something like a 20% level of your spending capacity that you used to enjoy at that time, right?
Correct.
So you cannot run away from equities when you reach a retirement stage. And see, the difference here is that there's a uh, there's a fear which is a short-term fear and a long-term fear, right?
Yeah.
The long-term fear is what I just explained, that you don't want to be running out of money, or you don't want to have complete erosion of your purchasing power. But it will happen in decades, okay, maybe 15 years or 20 years later. While a short-term risk is looking at a portfolio going like you spend 100, you invest 100 rupees and 100 rupees become 90 rupees. This is a short-term risk, right?
Yeah.
And people are so wary of this short-term risk, and because the long-term risk takes time, right? It's a gradual thing that happens.
Correct.
So we want to postpone that risk, and we want to try and ignore that risk, right? While we are very, very clear that, okay, I don't want to see any kind of erosion in my hard-earned, and obviously sacred capital corpus,
Correct.
and people move away from equities from that angle, right?
Yeah.
This is what we have clearly laid out and established in the report, that what happens, like if you ignore long-term risk and just focus on short-term risk, what really happens, and what we promote is on the flip side. And there is one more angle to this, that
Okay.
people also understand that, okay, 6%, 7% is not good enough for me, I want more, right? So
Mm.
there is again a angle of a short-term greed and a long-term greed, right?
Correct.
The long-term greed is equities, like it compounds over time. Everyone understands that.
Yeah.
But then everyone also knows that, oh, it takes time, right? The compounding takes time. You have to remain invested for a long period and so on, right? But there, the flip side is that people want to get rich, or have high returns in the quick succession, right? So they will say, okay, this is a particular company bond, it is giving 11%, 12%. This is some kind of a small cooperative bank, this is giving me 9% compared to 7% from, let's say, a nationalized bank, right?
Yeah.
They try to chase yields on wrong side, right?
Correct.
Which is extremely, that's like a capital destroyer in our terminology, which in one shot you will just lose a lot of your capital in that, if a bad event happens. So the focus should be long-term risk management, long-term greed, in terms of, you remain exposed, you build that capability of, seeing your portfolio fall 20%, 30%. But again, that also cannot be done recklessly, right? I just bought five stocks. I bought stocks of, some of the companies that fell so much that it cannot fell further, and things like Yes Bank and so on. So equities is extremely important, because that is a risk that you cannot do away with, but you cannot be reckless in equities. That's our science of alpha from safety, which says that once you come to a risky asset class like equity, so we agreed and established that, okay, you need significant allocation to equities, but once you agree to a fact and come to equities, then you have to chase safety.
Yeah.
Then you don't chase that, okay, can you give me the highest return? Obviously, highest return also happens when you chase safety, right? And that is what we have proven over our last 10 years of history,
Correct.
that while doing a diversified 25-30 stock portfolio, uh, focusing on not ignoring the overvalued, overhyped stuff, and you can still generate the highest return in the market, beating benchmark, beating a lot of other portfolios. So this is the approach that investors, even when they are entering the retirement phase or a consumption phase, that they have to follow. So there is no easy way about it. Behavioral aspects have to be taken care of first. You have to be comfortable about what kind of risk that you can take, but you cannot stop at saying that, okay, no, I cannot take any risk and I want to be in FDs. If you are doing that, you are fine in the near term, but you are in for a lot of trouble in the longer horizon. That is what we are trying to highlight there.
Absolutely, absolutely. So that's an extremely valuable insight, especially for investors thinking beyond accumulation towards sustainability. Finally, let's bring the entire framework into actionable clarity. And my last question of this segment before moving to rapid fire round is given everything we have discussed today, market regime, allocation, structure, risk, and sustainability, how should investors actually implement positioning today? So lump sum or staggered deployment, active versus passive, direct equities versus mutual funds. What is the practical roadmap serious investors should follow? Over to you, Mr. Shami.
Yes, so it goes back to the the whole process discussion flow actually that we have had so far.
Yeah,
It starts with the asset allocation framework first, right?
yeah,
It
yeah.
is it's never the lump sum versus staggered. Yes, you can obviously, depending on what is your life stage and where you are starting. So ideally it is always staggered. Like if I have not been investing in equities so far, but now I realize that I need to,
Yeah.
then there is no need that, okay, and 50% is my, let's say, equity allocation. There's no need to start doing that tomorrow, right? You can obviously stagger your investments over a period, but it has to be predefined and you have to stick to it, right? That's more important than because those events, those noises will continue to come ever, right? You have to define with the help of a advisor, a trusted partner, or a counselor that you kind of really believe in, and build your asset allocation plan. And then if you have regular cash flows coming in, right, then you are comfortable in terms of you can be slightly more risk taking in your equity allocation or your asset allocation, but you have to build your allocation over a period of time, which has to be laid out in consultation with your advisor, and you have to reach there and then recalibrate. Don't be very tactical in that every quarter you have to do some activity, every 6 months you have to do some, obviously, annual review, or that is something that you can have, and then you can recalibrate your asset allocation framework. uh, then what you are buying into, when you are allocated and you say, okay, this is my equity allocation, this is my other asset allocation. After that, the other points that we discussed, that how do you go about selecting a fund, selecting a structure, is where you continue to focus on diversification, you continue to focus on the expected return equation, right, which I told about, yield plus growth plus re-rating. And if that is favorable, and then you continue to recalibrate that, then that's all you need. And it's actually a it's good if it is not very exciting. I always say to my investors and people who have actually not looked at their portfolios every day in day out, have have gotten better outcomes than from the market than people who have tried to be extremely active about it, and get swayed into these kind of storied ideas. So that's the, I think, balanced approach.
Correct, correct. Got it. So thank you for those structured perspectives. Before we conclude, let's move to a brief rapid fire segment. And my first question to you, Ashwini ji, is one asset class you are structurally constructive on the next 3 years.
That has to be equities, and it's not only 3 years but longer. 3 to 5 to 7 years. Uh, the equities are expected to give good returns, I think.
All right. Large caps or mid caps for compounding stability.
So while this will keep changing based on at what valuation these broader market segments are, but as of today, large caps are more favored over mid caps.
The biggest micro risk investors may be underpricing today.
Um, I think really from Indian macro perspective, or Indian valuation perspective,
Mm.
I see limited risks today. But yes, in terms of if you're only focused to some of the overvalued segments of the market,
Mm.
then that is the risk that you're carrying in your portfolio.
Okay. One behavioral mistake that permanently impairs long-term wealth.
See, if you chase past returns and you want to invest in something which is going up, okay,
Mhm.
it works in the short term, okay, but that mindset permanently impairs your long-term wealth, and after after certain losses, streak of losses, you will just go stay away from that particular asset class, including equities. Like if you just come into equities when you see market going up,
Mm.
and then you end up buying a overvalued market, and you lose capital there, and then you say that okay, this is not for me, this is too speculative, but that's the problem, that your intent of why you came into the equities first price was not clear. You were chasing returns, right?
Mm.
And that can happen with any other asset class, including gold and silver and crypto, right? So if you just look at, you don't want to upgrade yourself, learn to understand the fundamentals and why things work the way work,
Mhm.
then you will end up chasing the trends and you will impair your long-term wealth potential.
Absolutely. So, and the final question is one principle every serious investor should anchor in 2026.
Yes, so 26 and beyond, I think it's always that you understand, what you are buying.
Mm.
Now, this might sound very generic, and then that's where the framework comes handy.
Mm.
But if you understand what you are buying and what is the valuation, what is the equation, fundamental equation that you broadly understand,
Mm.
you don't have to chase it day in day out closely, because or rather track it, because you can take the help of professionals on that front.
Mm.
But broadly, if you understand those things, right? People, I mean, we have seen people with a lot of high IQ and who are doing brilliant in various fields. On investment side, they just kind of tend to outsource or don't look into this, or either just do the wrong thing.
Mm.
Be very risk taker and do the wrong things at the wrong time. So I think it's imperative for everyone to understand the fundamentals of investing, and and that's a very key allocation, key aspect of creating long-term generational wealth.
All right. So that's it in this leadership dialogue conversation with Ashwini ji. Thank you, Ashwini ji. And that was a thoughtful, structured, immensely valuable insights. If you have any questions for Ashwini ji, we encourage you to follow Omniscience Capital and VRIGHT Exchange on the platform. The link is provided below. Feel free to share your questions directly. To our viewers, please stay connected as we continue helping you in the discovery of quality companies and emerging vision, where we spotlight forward-thinking organizations across four distinct categories. One is premier leaders, emerging champions, three is discovery zone innovators, and fourth is unlisted visionary enterprises. Our mission is simple: to deliver structured insights without noise and help investors discover credible growth stories grounded in fundamentals, leadership vision, and long term value creation. Thank you for joining us. Stay connected with us only on BRIGHT Exchange. No noise, just value. Thank you, Ashwini ji. Thank you so much for your time.
Thank you so much. Yeah, thank you, Anand.
Thank you. Thank you.